Washington, D.C. According to government data released on Thursday, the U.S. economy expanded more quickly than anticipated in the July-September quarter, demonstrating that despite alarmingly high inflation and Federal Reserve interest rate increases, the country is not in a recession. However, the economy is far from stable, and the third quarter's strong growth did little to change economists' growing opinion that a recession is extremely likely to occur next year. Consumer and company expenditure will almost definitely continue to decline as a result of higher borrowing rates and ongoing inflation. Additionally, the sales and earnings of American firms will decrease due to probable recessions in the United Kingdom and Europe as well as slower growth in China. A U.S. recession is anticipated to start in 2023 as a result of these tendencies. After 2 quarters of recession, the economy surged to a 2.6% annual pace in the July-September quarter. A significant decline in home sales and construction was partially offset by increased consumer spending and a surge in exports. A recession is often defined as a 6-month period of economic deterioration. But in a post-pandemic economy where GDP was negative in the first half of the year but the labor market remained strong with extremely low unemployment and excellent hiring rates, nothing is straightforward. Since growth abruptly came to an end in March 2020 when COVID-19 struck and 22 million Americans were suddenly out of work, the trajectory of the economy has baffled policymakers at the Fed and many private analysts. As Democrats fight to keep control of Congress in the midterm elections, Republican assaults on President Joe Biden and his fellow Democrats have made high inflation a prominent theme. What is the probability of a recession, then? Following are some queries and responses. Why do so many economists project an economic recession? They predict that firms and consumers would be overwhelmed by the Fed's rapid rate hikes and the country's chronically high inflation, which will force them to reduce their spending and investment. Further reductions in spending will probably result from businesses having to eliminate employees. So far this year, consumers have shown remarkable resiliency. However, there are indications that high borrowing prices and inflation have started to have an impact. According to the government report released on Thursday, consumer spending growth last quarter was only 1.4% annually, down from 2% in the second quarter and less than half the rate of a year ago. The data released on Thursday also revealed that corporations are reducing their investments in factories and buildings, and that rising mortgage rates have negatively impacted the housing market. These trends are anticipated to accelerate, most likely resulting in a recession.